Hi, Adam Gower here, founder of GowerCrowd and host of the real estate reality show at youtube.com/GowerCrowd and on good podcasts everywhere. Now, today's show is a little bit different. Today, we're going to be doing a weekly, the first in a series of weekly roundups with Dave Saxe from Calvera Partners up in the San Francisco Bay Area. He and I like to talk about the week's news during the week. We share emails, texts, and the occasional phone call just to catch up on what is going on. David is a seasoned real estate pro, has deep insight, particularly into multifamily, but also into other asset classes. And each week we are planning to do some updates on the week's news, just to keep you informed on the highlights of what's going on a regular basis. So that's all I've really got, actually. If you want to go to youtube.com/GowerCrowd, please, in the future, if we pluck up the courage, we might actually do these live on Fridays at 12 o'clock PT. Today, of course, is recorded. And if you want to see these episodes and you didn't see them live and you don't have access to YouTube for whatever reason, just go to GowerCrowd.com and find the podcast page there. And while you're there, of course, subscribe to our newsletter. It's totally free, goes out on Wednesdays, and has all the latest news. And some of that is what we're going to be talking about today. So without further ado, let's get on with this first episode of Weekly Updates, where Dave Saxe and I are going to be talking about the week's news in commercial real estate. What's been going on? Let's start with the easy one.
Okay.
Let's start with the easy one, the less controversial one than all the others that we've been chatting about that seem to have a lot of visibility, not for the best reasons, online, but regulators. So regulators have been encouraging banks to extend their loans. What do you think that means? And what, instead of having the mark to market, what do you think that means and what does it signal?
I mean, there's a number of things that could be going on here. One that comes to mind, and that we've been seeing in a lot of the news stories, is there could be a lot of distress that's coming and probably coming across the real estate sector, and to avoid too much of a crisis situation. Not that I'm saying that that's where we're going. They could be giving a passive aggressive signal to the lenders to let's let this ride a little bit longer. Please work with your sponsors. We know last time from the great financial crisis, you didn't want to be in the business of being a landlord, and you probably aren't going to want that again. And it's getting pretty ugly out there on the office sector. So I doubt that would be fun if these banks all became owners of all these office buildings.
Yeah, but do you think that they're signaling something? I mean, to me, it seems like if the instead of the regulators saying like they did the last time, mark everything to market, which had an immediate impact on banks' solvency, right? And a lot of loans immediately had to come off banks' books and forced a lot of failures. And there's an awareness of that. If they're saying it's okay, we're okay with you extending this time and not marking to market, isn't there a recognition that, or do you not think they're signaling that we think this time we can see an end to this cycle? During the global financial crisis, you never knew when it was going to end or if it was ever going to end, right? It was like all this doomsday projections as well. There'll be tanks in the streets and whatever. This time, they're anticipating something different, aren't they? What do you think they're anticipating?
Yeah, absolutely. There was an end we thought there would be, and there seems to be, although I think my brother just got COVID yesterday. So who knows? Who knows? My point is who knows when it's going to end. But generally, there was some more visibility into, okay, we shut down the economy, things are going to change. And once this gets solved, vaccine out, whatever, things are going to recover. So absolutely, I would agree with you that in some sectors of real estate, they're probably thinking that, yeah, we see an end to this. That being said, you know, the more I read, and there's plenty of stories out there, particularly about the office market, it's less clear to me, particularly when you look at individual downtowns, and it differs by different cities, how fast that's going to happen. You know, I'm here in San Francisco, and the hot topic of late is AI is going to fix the office market here. And all these companies are going to need, maybe that's true. All I know to finish on the point is it's pretty ugly out there. These buildings are pretty empty. I go to one every day, and who knows how long it's going to take. I mean, I could make an argument to you, for example, in San Francisco, that San Francisco needs to be completely redesigned downtown and thought about in a creative way before we see that. That could be many, many, many years. If that's not the case, maybe in other cities.
Yeah, I was just talking to somebody who said a recent McKinsey report predicted that office will be back by 2030.
Right, I saw that too. That's 7 years from now.
Yeah, that's so you got to have some long staying power to survive that.
Right, and to your point, is that if you're a lender and they're saying, "Oh, 2030," I mean, look, I do they really want to wait around that long?
Well, obviously not. Yeah,
probably not.
Yeah. Now, the other thing that was big in the news this last week, and we got to try and stay, like really topical, as this is the weekly update. But the news this week also talks about declining inflation. In fact, Mark Roderick, who's, as you may know, is the crowdfunding attorney out there on the East Coast, asked why there wasn't more comments about how inflation has come down so much. I saw a post that he had on LinkedIn. But declining inflation, but we also have a strong jobs market and continued robust health of the economy, counterbalancing Fed efforts to bring inflation down. Where do you think this is going? I mean, do the Fed's going to increase? Well, like, what's the impact, do you think, of inflation having come down, announced earlier this week?
I have a daily call with my business partners, and we're still having a lot of these debates, which is good that we're having them here. Especially, there's still so much uncertainty. So to your point, my only guess as to why we're not hearing more hype about that is because people aren't sure still what's really going to happen. In fact, this morning we were just still talking about where are they going to do another rate hike? Are they not? I don't think there's enough visibility there. And until there's consistent, sustained inflation at a level that makes sense for a while, I think only then will people start to get more comfortable. So I think people just learn to not make a blanket statement here too quickly, because, man, things are just shifts on a daily basis here, it seems like.
It's interesting, isn't it? Because if you think about it, inflation is a symptom of the problems facing commercial real estate. The actual problem are interest rates. But the idea is that if the symptom goes away, the Fed will start reducing interest rates. And as soon as that happens, there's just a flood of capital into the market, everybody thinking, right, we hit bottom, quick, buy everything you can as cheap as you can, because things are going to start going up again. But that's the point, isn't it? Is that and this is, I actually responded to Mark on LinkedIn. The point is that the impact of interest rate hikes has not been fully felt yet, has it? There's still a lot of, like, what do you think is going to be happening? What are you guys planning on?
Well, I mean, this morning we're close to getting under contract for a new apartment building, or not new as in it was just built, but a new acquisition. And we are having the real-time debate about how this whole loan application process and rate locking process will shake out. So we're having a debate right now about if we can, depending on who we're going with on the loan side, do we lock today? There's the next Fed meeting coming up. What are they going to do? How is that going to impact where interest rates go? And somewhat gambling. I mean, in a way, you just don't know. But that's a real-time example of how we're not sure. There's still a lot of uncertainty. And when we can't figure out quite yet until we rate lock what our interest rate's going to be, that impacts our return. It's a little bit more complicated. I'd say a lot more complicated to underwrite and value deals right now, because you could value something today and then in a week or whenever in the next meeting, our loan looks completely somewhat different. So the only thing we're doing when we put together a preliminary summary, as an example, is we're building cushion in. So, does the deal still work? If I don't tell the seller that, but if the deal does the deal still work, because they ask you that in a buyer interview, do you have room for an increase in interest rate? So that's a real-time example from this morning about how we are having a debate around this uncertainty.
Hmm. Right. So another topic that we've been talking about a lot from this week's news, and I'm going to because I actually don't mind, because it's all public, mentioning some of the names of what we've been seeing in the news. But at a high level, we've seen some very public discussions about sponsors, large-scale sponsors who have grown from zero to billions under management in multifamily, in Sunbelt areas, very, very quickly, who now are seeing reports in the press that everything that's available public about their loans, are that they're underwater, that their DSCRs are negative, and that they're in trouble, and that they are responding with publicly broadcasted videos. The mind boggles. See, what do you want to? Where do you want to take that, Dave?
Yeah, it's been quite a soap opera. Guess we can thank or not thank the Real Deal for these stories and the insight. That's where it all came about. And as a player in the multifamily space, I've been eagerly reading the coverage of that. And then I saw the 16-minute video response by one of the sponsors, which was very interesting to listen to, which was then followed by more Real Deal stories. And it seems to still be going here. And I saw another one today on one of the other sponsors. So it's fascinating. As somebody that raises capital, that is always thinking about how to raise capital, regardless of the source, we've just been blown away in a very impressed way by how these groups scaled. It's not easy to do in real estate. To their credit, they capitalized on it, and through whatever means, they were able to skyrocket their growth.
Right. I mean, guys that have absolutely no experience 5 years ago. Yeah.
Right. It's really, I mean, look, to their credit, they capitalized on the opportunity and they were able to sell it. I've been trying to focus in on how they did that. What were the tactics that they used? And I guess thanks to the Real Deal, even this morning, there was another article about kind of the business plan that they were pitching, which was really fast turnover of buildings.
In other words, buy, fix, sell fast, in and out.
Correct. That was a new piece of information this morning that could make a lot of sense on how they pitched this.
Right.
And how they saw really quick success, particularly if they streamlined and had a good way of renovating the units, quickly increasing rents in fast rising markets. So it's amazing that they did that. But, when you look at real estate, we know it's cyclical. We know interest rates and the amount of leverage you put on deals can really make or break you. And what seems to have happened here, if you take the word of the Real Deal and just logic, I guess, is if they were very aggressive or even not even normally aggressive with debt, if they have floating rate interest rates, if on their loans, if they have bridge debt, you name it, with interest rates skyrocketing, that decreases the value of multifamily. If any of their loans are expiring, they may not be able to refinance those loans on top of, with rents declining in Sunbelt markets, cover their monthly debt service payments. So it's somewhat of a double whammy here, right, where the market moves so fast on them in a complete way that would have torpedoed their business plan.
Exactly, especially if you're trying to do you're trying to get in and out fast. And now
you always need to bake in the into your numbers, what happens if things shift. Now, I'll defend them a little bit that, look, did we see interest rates rising this fast? No, but I'd say we're more conservative in how we look at things. So there was more room for a movement to happen and not have us be in the Real Deal.
Look, and we don't really know much about the real details of these stories. And wherever I post this episode, I will include links to the articles that we're talking about.
Yes.
But one of the things that you've mentioned that has become a common theme, Dave, in conversations that I've been having recently with services and special services and other workout guys and real pros in the industry, is management capability, right? The ability to manage a property really from day one and not not to be casual about. I mean, that's one of the most important aspects of success in this business, isn't it?
Yeah, I mean, we have a new blog post, although we're actually about to roll out a redesign of that page, but a blog post on this. So, seeing what happened, and I think my business partner wrote it, and trust but verify the sponsor. So I think these folks were very good salesmen, and to their credit, but you always want to know who you're delegating all your real estate decisions to, and how conservative are they being, and how are they looking at risks and mitigating those risks. So it's absolutely critical to ask those questions, see what the experiences that they've had. Have they worked through downturns before? Yeah. Because this is where you learn who the good folks are, is not when things are going like this for everybody, but it's when they start going like this, and who survives and how have they thought about that. Exactly.
When times are good, anybody, you've got a heartbeat and a checkbook, you can make money. But the real sign of excellence is the ability to navigate and survive these kinds of times. Now, the other thing that you and I were chatting about in this regard over the last week was how did they do it? What do you think? In terms of raising these gazillions of dollars. What again, the Real Deal did mention individual investors. It mentioned hundreds of individual investors, institutional capital as well. And you and I know that they also raised money on crowdfunding websites. But what do you think? Like, what would you do differently if what do you think you can learn from that?
Oh, I've been trying to really dig in. I mean, again, we're really impressed with the scale. I mean, let's forget, if we can for a second, what's going on now. But any company, the ability to raise that kind of money and skyrocket at that growth in an industry that typically you can't grow that fast, it just never happens that way, is incredibly impressive. I spent a little time this past week digging into each of those groups and trying to see where their money came from, and it was different for everybody. I mean, you had some folks that came from established multifamily companies or other quote unquote institutional players. So, good resumes, although they're really pretty young guys. You probably had some others that probably came from some resources, so that when you combine those two, that probably was helpful. I have to believe all these folks are very good networkers, good salesmen, kind of like in tech. They probably leveraged that. The parts that I'm less sure about is, what was the message? And what were they telling potential investors, and is that still true? And what were the promises made and things like that? Because they clearly, for a while there, although it may have been a short period of time given the growth, very much delivering on what they said until
they weren't. Yeah.
Exactly. It's So
and I'll tell you something. There's this investor mentality as well that I've seen or heard kind of vaguely that, these guys have made us so much money over the last few years that, we're okay with a loss. I mean, it depends how much, if you're like rolling over again and again and again, doubling down, and eventually it all just goes poof and vanishes. That's a different story.
Yes. And we work with a lot of different investors. So much is this psychology. So that's what I've learned the most about fundraising over the many years now. I've talked to so many different people, and someone's personal background, what industry they came from, what industry they work in, their age, past success, what they think they know about real estate, tech or not tech folks. It's that all impacts how someone evaluates a sponsor. I totally buy into the fact, though, that if they were very successful for folks for a while, they're going to get a little bit of wiggle room. But now is the important part. How is this all going to shake out? And can they get out from any mess that they're in? And are they just being candid and honest with the folks that have given them money, as well as folks that may be thinking about them for new investors? That's what you want in a sponsor. And for all this stuff, I can't 100% speak to it because I'm not inside, and I am relying on what I'm reading in the news and my own personal experiences working in real estate for a long time now.
Well, this is just informal chit chat, but maybe video recorded published YouTube rebuttals to articles isn't indicative of somebody who has really had the experience of how bad this stuff could get.
Yeah, I mean, I would say the age of the folks, most of them, I think, if not all of them, and their lack of experience over a number of years stood out to me. And who's giving them the advice on something like that? You know, I watched the video, and I guess I didn't find it overly compelling in terms of everyone's having problems and blah blah. What I'm expecting, I guess it's the press, and I guess Real Deal does do a great job of being topical, and their articles definitely catch your attention. So knowing that about the publication, I'm not terribly surprised that they responded to the video in the way that they did. Right. And yeah.
Well, you know what it is, actually. You know what it's like? It's like what Zuckerberg and Musk talking about.
Yeah.
It's a cage fight.
It totally is. And I'll end with this. When we think about actions that we do going back to the beginning of our company, and I've told investors this, and it's absolutely true. It's, would my 97-year-old grandmother approve of what I'm doing? And am I taking actions that would potentially get me in the front page in a bad way of any real estate publication? That's always in the back of my mind. I probably would have taken a somewhat different approach.
So look, let's do wrap up with kind of lessons learned from this. And one of the biggest challenges, I was talking to Michael Episcope at Origin Investments years and years ago. Yeah, they're an amazing shop.
Yeah.
And one of the biggest challenges that he articulated that we actually brought out of some of our other clients, because they didn't realize or were unable to articulate what the challenge was. But Michael was very good at that very, very early on in the way that they did it. That was, they were prudent, and I suppose are prudent. With the CYA, I don't know them super well, right? But presumably they are prudent, long-term investors. And so one of the challenges that they faced in this last cycle was competing for investor capital, particularly individual investor capital. And this last cycle, right, since 2012 has been the first time that individuals have been able to invest wholesale because of crowdfunding and online syndication. And it's been the first time that sponsors have been able to solicit people online, general solicitations, first time it's been allowed. So this is the first real downturn. And one of the challenges that prudent sponsors face, and this is probably, you kind of alluded to this a little bit when you said, I'm impressed with how they did it, but I'm not quite sure the language they used.
Right.
Is that what was driving investor interest? And this is commonplace. We know this because we've seen whenever the IRR was high enough, more people would show up at webinars. So the higher the IRR, the more interest there is, presumably because investors think, well, at least they're aiming high. If they fall short, they'll just fall short. But the reality is you fall short, you actually lose everything. Mm-hmm. So one of the challenges that sponsors like you have faced is that you're in the market with prudent, well underwritten, carefully thought out projects that have IRRs that on their face don't compete when you're dealing with investors who are just looking at that. So how do you deal with that? Right? That's really what we're talking about. And then the assumption is if you've been fixing and flipping large buildings over very short periods of time, what does that do to your IRR?
It just drives it way up.
Stupid high IRRs, right? And that betrays the undercurrent of what's really going on and how risky the investments are.
Right. Real estate is a long-term investment. We've always looked at it that way. Anybody will tell you that. You never know what's going to happen, and you have to have a long-term, well thought out business plan with, as you said, carefully underwritten assumptions. I get frustrated, to your point. We were trained at CIM, all three of us, to be very conservative and have defendable assumptions. We're also generally conservative investors with a long-term view. So we in our guts we've never gotten comfortable for showing an IRR that isn't carefully backed up and under scrutiny. Now, what does that mean? We've lost the ability sometimes to put our deals on some of the crowdfunding sites because we haven't been comfortable with the IRRs. This is more back in the day that they wanted to see for that because it wouldn't catch the attention of the folks that you're talking about.
Right.
So on the one hand, it's really challenging and frustrating because you do see folks going from 0 to $1 billion with that. But at the flip side, I can sleep well at night and know that my assumptions were something that I can live with.
Right. And potentially over the next few months, pick up some of the pieces as well.
Correct. I think that's why we wrote a blog on, I don't know if there's a better word for blog now, by the way. We wrote an insight piece on our website about this.
Oh, interesting. All right. So listen, send me a link to that. I'm not sure quite where I'm going to post all of this yet, because as it is the weekly update, I've got to figure that out. I want to do it super fast as well, because I want to get it out today if I can.
Things change fast.
Things do change fast. So let's see. Let's first of all, thanks for doing this, Dave.
Yeah, thanks for having me.
We've been playing with it for a couple of weeks. I'm glad we got together. Yeah. Let's do a couple more of these recorded. And once we get comfortable with our mutual discretion and ideas, we can take it live one week and hopefully don't blow everything up. But anyway, thanks for joining me today. It's been a pleasure, and I look forward to doing it next time.
Sounds good. Appreciate it.